Welcome to the Financial Foundations podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolfe.
Welcome, everyone, to the Financial Foundations podcast, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe, certified financial planner.
And in today's episode, we're going to discuss a common topic and question that comes up during financial planning sessions, and that is financial planning for new and existing parents. And that can range from just setting your child up to have a better future or planning for their education or both. So we had a question recently come in. By the way, if you have any questions, please email us at question@basewealthmanagement.com, and we will probably feature it on this podcast. But we had a listener who is expecting a baby in a couple of months. He's currently 37 years old, and his wife is also 37. And he just had some questions and concerns about preparing for his child's future and, education. So one of the questions was, how should he adjust his budget for upcoming baby expenses?
Yeah, so when you think about the types of expenses that you're going to have as a parent, you have some pretty big expenses, especially if you're sending your child to, for care, like to daycare or something like that, or a babysitter. That's going to be one of your bigger expenses. And then you just have the day-to-day expenses of all the things that you're going to need to take care of the child. So when you think about that, you want to kind of come up with a strategy where you're like itemizing all those expenses on like a spreadsheet or something like that, and how much that's going to cost a month. So that way you can factor that in to the amount of income you're making from your job. I don't know whether or not both parents are employed, but that's going to be a big expense having the baby. And the thing you can do is set aside money from your paycheck to be like automatically transferred to like a savings account or something like that. Like you could if you want to save for the child's education, which we'll get into.
Yeah. So he also asked what sort of things should he consider regarding like retirement planning in general with this new baby coming.
So hopefully this couple is stashing money away for retirement, and whether or not they're doing it directly from their paycheck or they're just automatically contributing to IRAs or Roth IRAs, there's a lot of factors there. The goal would be to not reduce their retirement contributions significantly, but there are plenty of people that have to adjust their retirement contributions while they start, saving for this additional expense that they'll have with the baby. And you can reduce your retirement expenses or contributions to your retirement plan into like just a savings account that you can spend that money on caring for the child.
Right. Are there some considerations that should be taken into account for employee-sponsored retirement plans as well?
Yeah. So if you're contributing to a retirement plan through your employer, you can hopefully maintain whatever you're saving aside from that. So in addition to whatever you're saving in your 401k or IRA, you may have additional savings every month just from your paycheck in your checking or savings account. But if that's not going to be enough to cover these additional expenses with the baby, you may have to reduce your contributions into your employer-sponsored plan. So if you're contributing like 15%, which is a big number, for most people, they're probably not contributing that much. Maybe it's more like 10. You could back that off by a couple percentage points and put that money instead into savings to cover those additional expenses. But I would encourage you to leave on the annual increase. Most 401k or employer-sponsored plans allow you to automatically step up your contribution every year without you having to go in and adjust it. And usually people do like an additional 1% every year. So I encourage you to leave that on because hopefully you won't notice an additional 1% coming out of your pay. But in the meantime, while you're planning for this baby and when it arrives, you may have to back down your contribution in the short term.
Okay. And so that sounds like the listener's retirement plan. Now, what considerations should be taken? I mean, I myself have seen things online all about the power of compounding, and I think that a lot of people don't understand that when the baby is born, they should probably start investing money into a retirement plan for them, right? Or what's the balance in that and education, or how does that all work? What's your take on that?
Yeah, it's a really good question. And it can depend on, obviously, your financial status and how secure you are. If you are able to start contributing to like a 529 or college savings account for the child, the earlier the better, because of compounding returns, of course. So I encourage people that can to save early and save often. However, I know that's not going to be possible for everybody, but anything that you can contribute definitely can. And some people say, well, I don't know if they're going to go to college. There's been some recent revisions to the Secure Act a couple of years ago that allow people after 15 years of the 529. So like, say you start a 529 today. In 15 years from now, you can roll over some of that money if it wasn't used for college, or if it's left over, if they went to college and there was still money left over, or if they never went. You can roll over up to $35,000 into a retirement account for the beneficiary of the 529. But you are subject to annual contribution amounts to an IRA. So you can't roll $35,000 in 1 year to an IRA. You'd have to do it over several years up to the annual contribution amounts. And that would be for anybody who's a beneficiary of a 529. There's really not any type of caveats to that other than the contribution limits.
And what are the current contribution limits for the 529 account while we're on that topic?
For the 529 account, typically people stay with under the annual gift exclusion without having to file a gift tax return, which is $17,000. But you can front load it where you do 5 years worth of exclusions. It's $17,000 per person. So if you're a married couple, you could contribute $34,000 to a 529 per year without having to file a gift tax. But you can do 5 years worth and front load that, but then you wouldn't be able to recontribute for 5 years.
Okay.
But that's for, very well-to-do people to be able to contribute that kind of money in 1 year to an account for your child.
Right. And so that's answers a little bit of the question about the 529 accounts, but what about just a normal custodial account? Is there a mix, like should part of it be in a normal custodial account and part of it in a 529, or what is a typical recommendation?
Yeah, so with getting kind of into the details of what a 529 is used for, and then I'll answer the full question. So a 529 is for college education, but new laws allow for it to be used for private education, K through 12. So if you send your child to private school, you can use money in a 529 for those expenses. And also they've gotten a little bit more relaxed with the rules on what qualifies as education expenses. So before it was pretty much tuition and room and board, but now you can use it for off-campus housing, computers, laptops, iPads, anything that your child needs to be supported, not a vehicle, but I'm sure you could probably maybe get away with buying a bike or something like that. But I wouldn't recommend trying to pay for a car with a 529 account. But they have definitely relaxed some of the rules on what qualifies for expenses. And the great thing is all the gains that you experience. So if you start saving for your child now, and that 529 account is $50,000, any money used for qualified expenses is completely tax-free. So any growth on that, if you hopefully invested that money for those years, you're not paying taxes on. So for someone who doesn't know necessarily if their child is going to go to school or like college, 529 can also be used for trade school too. But if they're not going to school, then if you take that money out and you don't utilize the rollover, then you're going to pay taxes on the gains and a penalty. But another option, as you mentioned, is like a custodial account, which doesn't have to be used for education. So if you start stashing money away into what's called like a UTMA or UGMA account for the child at 18, or in some states 21, when they become an adult, or like a legal adult, that money automatically gets turned over to them. So if you save $20,000 into an UGMA or UTMA account, when that child reaches adulthood, that money's theirs and they can do whatever they want with it. So whether you think they're responsible with that money or not isn't really up to you. They could spend that money on whatever they wanted to. So that's the downside if you don't utilize a 529 or education account, and just a custodial account is that money can be used for anything, which is a good thing, but also could be not so good if they're not responsible with that money.
Right. We don't want to get into parenting in general, but I think that you would probably agree that it's important to educate children on, finances and stuff like that, so that if you did open a custodial account, they wouldn't spend that money on, I don't know, a new car or whatever.
Right. I would definitely start with them at a young age, teaching them the responsibility of money. And you can do that through, rewarding them or compensating them for chores around the house and things like that. So that way they have a healthy relationship with how money works and that you earn what you make.
There are even, again, I don't want to get too much into this, but I've seen apps for kids that will take some money, each week and deposit into their account. And then you can, whenever they want to buy something at Walmart or wherever, you say, okay, well, do you have enough money for that?
Right.
And it teaches them how to save and the importance of money. So another thing that, I'm thinking about in general is going back to that compounding effect. Just in general, how much does it hurt if, your baby's a newborn versus if they're 5 to start saving? Or would you just recommend that either way?
There's definitely going to be a benefit if you start when they're a newborn, as soon as you get a social security number for them, because that's when you can create a 529 or a custodial account and start contributing, is when you have a social security for that baby. And the earlier you start, the more years of compounding returns you have. Same as if you enter the workforce right out of college or right out of high school and you have access to contribute to your retirement plan, the earlier you start, the better off you will be in the future. Now, I say that, but no time is a bad time to start saving. So even if you wait till they're 5 or 6 years old, it's still a great time to start, but you're maybe slightly behind and you won't have those 5 years to necessarily make up. So there is a great benefit to starting early, really.
Right. I've seen some tables out there online where, you could contribute, I want to say something, maybe I don't want to put definite numbers out there, but it was something like $1,000 a year up to the year that they're 18. And that would grow by the time they retire. It would be, millions of dollars, even if you stopped at 18. Whereas if you start at 18 until they're 35 and they start contributing, it's going to take a lot longer and a lot bigger net investment to reach those kinds of numbers.
Yeah. Those tables are staggering to look at when they show you what the compounded return is if you start saving at 18 versus 30. And you can't make up that difference without adding a significant amount of savings every year, but it will cost you less out of your pocket if you start earlier.
So to me, it really sounds like it's very important to put in as much as you can in the early years whenever they're born, and then keep contributing as long as you can.
Yes, I know it can be difficult. It's easier said than done. You may not necessarily have a lot of excess cash flow when that baby's born. You may have medical costs that you're still trying to pay off, the increased cost of childcare, just the general day-to-day needs of that baby. But yes, I encourage you, it'll pay off if you can save earlier, but contribute as much as you feel comfortable.
Right. Okay. Yeah, I think we've hit that point home there. So now let's talk about everyone's favorite topic, and that is taxes. What considerations should we take into account for having a new kid with taxes?
So I want to touch on some taxes for the 529 account first. So for states that have state income tax, you may be able to get a tax deduction or a credit. Some states do a tax credit for a certain amount of your contribution. So definitely check out your state's tax laws when it comes to being able to deduct or get a credit for contributing to a 529 plan.
By the way, we are not accountants, and this is not tax advice. We are just sharing this information for educational purposes.
So there's some things to think about now that this listener is about to have a child when it comes to taxes. And again, reiterating, this is not tax advice. So there's two credits. There's a child tax credit and a child care or dependent care tax credit. And the amounts vary, and for some people they may not qualify depending on their income and their modified adjusted gross income. But the amounts of the credits can vary, but generally for a qualifying dependent for the child tax credit is $2,000. And for the child care, for one child, up to $3,000, and for two or more, the maximum is $6,000. But again, consult with a tax advisor or the CPA that you work with, because you may or may not qualify and be able to take advantage of the full credits for each of those.
So in considering, these tax implications of having the child, if someone does do a financial plan, then the tax planning portion is generally included in that. Is that right? And how does Base Wealth Management handle that?
Yeah, so no doubt with the holistic or comprehensive financial plan, plenty of that has to do with your tax plan. So we want to work with our clients and their CPA, or if they don't have one, we can refer them to a CPA that we've had clients use in the past that we can recommend if they don't already work with somebody. But together, we'll work with that client, since we don't provide tax advice, but we can give some education and guidance like we're doing here today. And some of that can be for helping plan for doing Roth conversions, or are eligible to contribute for a Roth. We can kind of give you the answer on that. It's pretty simple depending on your income, etc. But there will be instances if it's bordering on tax advice, we will loop in the CPA and bring them into the conversation depending on that question.
So now that we've dabbled in taxes, how does someone like yourself, a certified financial planner and expert, feel about things like leveraging insurance for the newborn, or just insurance in general for your child?
Insurance is definitely an important topic. And I like to start with basic life insurance for the parents. Obviously, if they're both working, or if one's working, you're very financially dependent on that one parent. But if you're both working, you're going to want life insurance to help cover the loss of life and the income that individual was producing for the family, and whatever costs additional you want to cover. So with the loss of life, their income goes away. So you want to cover that income for maybe a certain type of period. You can get like a 20-year term life insurance policy for fairly inexpensive on each of the parents. So you want to cover not only what they brought in, but maybe additionally items like a mortgage or paying for college with life insurance. You can do that, as I mentioned, for fairly inexpensively, and other items that maybe you would have covered with that person's salary or income.
So, even for someone like myself, one of the hangups of getting life insurance is I really don't want to take that test. Have you found that in these more modern times that a test is not required, the health test?
Yeah, good question. So depending on the level of insurance you're looking for, so if you're looking for like $200,000, you probably won't have to take like a health screen or test. But if you want $1 million, they're going to want to test you. And depending upon your health condition, pre-existing conditions, etc., you may be hard to insure, but there are insurance brokers that you can work with that know if you're harder to insure, that maybe they're going to have to go to certain life insurance companies that will qualify you that you may not qualify for others.
So I think that, it's important to understand if I could gain any sort of insight from this whole episode and the various topics we've talked about, from, the choosing a custodial account or 529 account or a mix of both, life insurance, the tax implications of having a new child, and just saving in general, whether you have a newborn or, however old your child is. It's that it's important to, talk to a professional so you can give them a complete idea of your personal situation, because each financial plan is specific to you and your circumstances and how much you can contribute and, what kind of life insurance you need. It's all specific to your situation. So I believe that that's probably one big takeaway. Alex, could you summarize what we've gone over here in a few points to summarize?
Yeah, definitely understand that it can be stressful when thinking about finances with a baby on the way, and working with a professional and having these conversations is definitely beneficial and can alleviate some of the stress that you may have. And when it comes to saving for the baby's future, whether it be just setting them up for success or paying for their education, there are different vehicles that serve different purposes for what you're trying to accomplish, and maybe a combination is the best route to go, or all one way or all the other way. But there's definitely avenues that may be more beneficial depending on your circumstances and the goal you're trying to accomplish. When it comes to life insurance, it's definitely important to have some type of base coverage in case there is a loss of life on either of the parents, and supplementing that loss of income seems to be critical to the financial health of the surviving family members. Also, there are different tax credits depending on how many children you have, what your modified, gross income is, and consulting with a tax professional on those matters is definitely important. So that way you can take advantage of some of the credits or deductions for contributing or just having a child that are out there.
All right. Thank you for joining us for this episode on financial planning for new and existing parents. If you want more information or you're interested in learning more about various financial topics, you can check out the Base Wealth Management website at www.basewealthmanagement.com. You can also follow Base Wealth Management on all social media channels. Just search for Base Wealth. And if you have any questions to feature in future episodes, then send those to question@basewealthmanagement.com. I'm Dustin Taylor.
I'm Alex Wolfe.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolfe, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.